Hi, my name is Pim Tawirat. Today we'll be presenting our financial derivative project. First, let me introduce my group members. Ms. Dolada Riao Papakun, Mr. Warayut Pikun Sawat, Ms. Yanisa Wilay Ratana Suwan, Mr. Jirapum Jaturon. Stark Enterprise is planning to issue bond in the next 3 years. The company wants to eliminate the interest rate risks by using suitable hedging instruments. One of the alternatives that can be used is swaption. I'm sure all of you guys have heard of options and interest rate swap. Swaption is a combination between those two. It is a type of financial derivatives that has interest rate swap as an underlying asset. In an exchange for an option premium, the buyer gains the right but not the obligation to enter into a specified swap agreement with the issuer on a specified future date. Swaption are traded over the counter whose participants are mostly large corporations, banks, financial institutions, and hedge funds. They typically use swaption as a tool to manage interest rate risk arising from their core business or financing arrangement. On a swaption contract, the buyer and seller of swaption agree on the premium of the swaption, length of option period, length of underlying swap period, notional amount of the underlying swap, and the fixed rate or the strike of the swaption. In addition to the settlement day, there are two types of settlements: cash and swap settlement. Cash settlement is when the payer pays the buyer the current market value of the underlying swap based on the predefined fixed rate. On the other hand, the swap is entered into by the two parties based on predefined terms for swap agreement. There are two types of swaption, which are payer swaption and receiver swaption. Payer swaption or put swaption gives holder the right to enter into interest rate swap, where he pays fixed rate or strike rate in an exchange for the float rate. On the other hand, a receiver swaption or call swaption gives holder the right to enter into interest rate agreement to receive fixed and pay float rate. There are three main categories of swaption: European swaption, American swaption, and Bermudan swaption. European swaption can be exercised only on an expiry date. American swaption can be exercised on any date that falls within a specified range. Bermudan swaption can be exercised either on swaption's expiry date or other predetermined exercise dates. Now, you might be wondering how the swaption is practically used in real life. Swaption can be served in many purposes. It is mainly used as either a speculative or hedging instrument against the interest rates movement. First, swaption can be used for speculating on interest rates. A speculator will buy a payer swaption if he expects interest rates to increase. On the other hand, he will buy a receiver swaption if he expects the rate to decrease. Let's look at the following examples for a clearer illustration of how it works. Suppose a speculator expects the rate on 5-year fixed-rate bonds to increase from their current 8% level. As an alternative to a short T-note futures position or an interest rate call, the speculator could buy a payer swaption. Suppose the speculator elects to buy a 1-year European payer swaption on a 5-year 8% LIBOR swap with a notional principal of 10 million baht for 50 basis times the notional principal. On the exercise date, if the fixed rate on a 5-year swap were greater than the exercise rate of 8%, bing! Then the speculator would exercise her right to pay the fixed rate below the market rate. If, for example, the 5-year par value swap were trading at 9% at swaption expiration, the value of swap that he can realize would be equal to the present value of the interest rate differentials times the notional principal. The value of swap in this case will be approximately 390,000 baht. However, if the swap rate at the expiration date were less than 8%, then the payer swaption would have no value and the speculator would simply let it expire, losing the premium he paid. Now, suppose the speculator expects rates on 5-year high-quality bonds to be lower 1 year from now. In this case, his strategy would to buy a receiver swaption. Suppose this speculator expects to buy a 1-year European receiver swaption on a 5-year 8% LIBOR swap with a notional principal of 10 million baht for 50 basis times the notional principal. If, on the exercise date, the swap rate on a 5-year swap were less than 8%, ding, then he would realize a gain from exercising the swaption. If, for example, the 5-year par value swap were trading at 7% at swaption expiration, the value of swap that he can realize would be equal to the present value of the interest rate differentials times the notional principal. Value of swap in this case will be approximately 400,000 baht. However, if, on the exercise date, the swap rate were greater than 8%, then the investor would allow the receiver swaption to expire, losing, in turn, her premium. In addition, swap can be used to hedge debt and assets position as well. Swaption in this case serves as an interest rate protection tool. Payer swaption acts as a cap on the rates paid on debt positions, while receiver swaption acts as a floor on the rates earned from asset position. First, let's take a look at an example of how the firm can use swaption to hedge its debt positions. Nippon Company is planning to issue a 5-year bond in the next 3 years. The company is worried that interest rates could increase in 3 years, and so it wants to cap the rate it would pay on its future 5-year bond issue. The firm decides to purchase a 3-year payer swaption on a 5-year 9% LIBOR swap with the notional principal of 60 million baht. The swaption premium is charged at 200,000 baht. At swaption maturity, which is year 3 in this case, if the interest rate is higher than the strike of 9%, the payer swaption will have a positive value so that Nippon Company will exercise the swaption. If the swaption is cash settled, Nippon Company will receive cash value of the underlying swap. Since interest rate increased, interest it pays to bondholders will be higher as well. The cash it receives from exercising the swaption will offset the higher cost of borrowing, resulting that the debt obligation is capped at approximately 9%. However, if it turns out that the interest rate is lower than the strike of 9%, the swaption has zero value. Nippon Company will let the swaption expire worthless and issue a bond at the lower borrowing rate. Therefore, With a payer swaption, Nippon Company can cap its debt obligation at 9%, regardless of how interest rate rises, while it can still enjoy lower cost of borrowing if interest rate declines. Next, we will see how the firm can use swaption to hedge its assets position. Suppose that the fund manager is planning to invest 30 million baht in treasury notes for 5 years, in 3 years from now. It is currently trading to yield 6%, but the fund manager is worried that the interest rate could be lower in the next year. To establish a floor on his investment, he decides to purchase 3-year receiver swaption on a 5-year 6% LIBOR swap with the notional principal of 30 million baht. The swaption premium is charged at 100,000 baht. At swaption maturity, which is 3 years later, if the interest rate is lower than the strike rate of 6%, the receiver swaption will have a positive value so that the fund will exercise the swaption. Given that the swaption is cash settled, the fund will receive cash value of the underlying swap from swaption counterparty. Since interest rate decreased, the rate it receives from T-notes will be lower as well. The cash it receives from exercising the swaption will compensate the lower return on its investment, resulting that the asset position has a floor of 6%. However, if it turns out that the interest rate is higher than the strike of 6%, the swaption has zero value. The fund manager will let the swaption expires worth less and invest in T-notes that gives a higher interest rate. Therefore, with a receiver swaption, the fund can establish a floor of its return on asset at 6% regardless of how interest rates decline, while it can still enjoy a higher return if interest rate rises.